It just got worse. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, world leaders are in shock as a major economy continues to spiral out of control. And we're going to talk about just why this economy is so critical and has everybody on edge. Because what is happening there is threatening to happen to every major industrialized economy across the world. And at this time, there seems to be no end to its downward spiral. And in fact, there's something that's about to make it a whole lot worse. So let's head over to Bloomberg, where we picked today's story up with a headline as China's economy is under pressure as inflation drops at the fastest pace in 14 years. And yet we continue to hear from the central elites, particularly the Federal Reserve, that inflation is here to stay. And even though it's coming down and likely to get to their target by the end of the year, that inflation could resurge in a major way. And yet here we see the world's second largest economy, the world's largest exporter, is facing persistent disinflation that has now turned into outright deflation. The consumer price index dropped 0.8% in January from a year ago. This according to the National Bureau of Statistics. The weakest. This is now the weakest since September 2009. So you have to think we were coming out, of course, of the global financial crisis, out of a deflationary environment. Now we're headed into one. Many said this couldn't happen. Yet we've made the case repeatedly that inverting the yield curves and the money curves by global central bankers would indeed cause a systemic problem that would end in deflation. Here we're seeing just the beginning. The drop was far worse than expectations of a 0.5% decline, again putting demand in China in a deflationary zone. As the CPI shows, China faces persistent deflationary pressure and needs to take actions quickly and aggressively to avoid the risk of deflationary expectations to be entrenched among consumers. And what that means, of course, if people believe that prices are going to fall in the future, they likely will restrain their purchases. In reality, what this actually means is demand is contracting, and that even if people want to consume in the future, they don't have the confidence, or more importantly, the money or the credit to make those purchases. So what happens, just as inflation builds upon itself, well, deflation builds in the opposite direction, and this is going to make for massive calls from world leaders to tell Beijing, you need to stimulate and do it fast, because where you go, well, the rest, as you'll see, will follow. And the evidence is strong because the producer price index fell 2.5%, still in deflation, marking 16 straight months of deflation for factory gate cost. Now remember, the U.S. exports inflation in terms of dollars. China exports deflation in terms of goods and services. So when you see factory gate prices in deflationary zone in China, it is mean exactly what it suggests, that consumer prices around the world are likely to stay low and potentially head even lower. As we look at the consumer price index in blue against the import price index from all industries in China, and of course both on a year-over-year rate of change, and we can see that generally where the red line goes, the consumer price index falls with a small lag. And sure enough, right now you see that import prices from China coming out of those factories in deflation is going to suggest that there's going to be further downward pressure on the consumer price index. And yet, as we talked about in yesterday's show, the Fed Chair Powell, they don't see any signs of this. The fact they're more concerned that inflation is going to go back up. But with China in deflation, not a chance of that at all. And the latest data comes as calls mount for China to do more to stimulate the economy and reverse a stock market slide. This is a big problem because, of course, confidence in the world's second largest economy has flagged despite efforts by the government to add stimulus, which we'll argue isn't enough. They're going to need massive rate cuts here, including measures such as unleashing long-term cash for banks and issuing more government bonds to fund construction projects. And this means, as we know, that of course, the central bank in China, the PBOC, is likely to cut rates. This will be a huge boom for their equity market, at least on the onset, to try to convince people that indeed the deflationary environment is gone. But one thing that you do need to put a big boost behind your trading account, well, you asked for it, we did it. Well, our CTA Timer Pro now on the first page. We're not showing that here, but you can still jump in and subscribe. You'll ask when the signals reverse. Steve, you said, look, look, I don't have time to go through your report. Can you just show us when the signals reverse so I can trade them? Well, you got it. Let's talk about our update on our QQQ trade, because our CTA Timer Pro looks at the machine positioning, and way back in October, what we saw is it came off a short position. Now, when that happens, you'll get a signal on the first page. And of course, same thing is true with our Momentum Timer Pro. Now, the difference is our CTA Timer Pro, again, looks at the machine positioning, runs a historical overlay, tells you when the probabilities are at an extreme low and to your advantage. Momentum Timer Pro looks at all those technical signals that many people try to trade and they get it wrong. We smooth them all out for you. And what we can note, on October 9th, both of our signals flashed move higher. The machine positioning and technical shifted, and now that trade, had you put a buy at open and handled that initial move lower in QQQ, you'd be up a whopping 19.5%. That would be a huge boost to anybody's trade accounts, and now we just made it easier for you. There are 10 coupon codes left. I put some codes up for a free month since they came out with the updated report. There's 10 left for each of them. Grab them, links in the description below. As China has been beset by falling prices for much of last year, the nation struggles to revive domestic demand and consumer confidence. And this is key because we talk about how consumer confidence gets people to spend. And in a debt-based economy, that's exactly what you need. People to go out and borrow money to buy things that they don't need and do it today. That is critical. That is how money is indeed created in our economy, is when commercial banks lend, and all of that occurs as consumers and businesses borrow more money and spend it and inject it into the economy. And when you see that happen, well, equity markets go up and confidence goes with it, as measures of economy-wide prices marked its longest slide since 1999 in the fourth quarter, underscoring the magnitude of the challenge as policymakers look to boost growth this year. Again, why I am calling for a rate cut in a big way from the PBOC. They're afraid to do it because they know that global central bankers do not want to cut rates right now. They don't want to do it yet. They're going to be forced to, and because the challenge here, it's going to send the yuan lower. Everyone believes at least a weaker currency. That's not exactly what, of course, Beijing wants right now. The reality is it's what they're going to get because they don't understand. Their currency is tied to demand. And when global trade and everything else collapses, well, so too does your currency. And as we talked about, there's something that's making this entirely worse for China and could be the tipping point that sends them off of this edge deep into a recession. We'll talk about that a bit later, but right now let's talk about consumer sentiment. Here we have the Consumer Price Index in blue on a year-on-year rate of change against the University of Michigan consumer sentiment. This, of course, U.S. data. There's something interesting here because normally what you see is that consumer confidence will come down at the beginning of an disinflationary cycle, and then you get a rebound. And then notably what happens is it comes back down again. And you see that happen here in the dot-com bubble, kind of started to make a rebound as consumers celebrate, hey, inflation's going down. And then all of a sudden they said, wait a minute. And then all of a sudden we notice confidence nosedive back down again. This happens in the global financial crisis. And the question is now, it hasn't happened yet, as everyone's getting excited that inflation indeed could be down and the labor market intact. The question is, can that dynamic hold? I'll show you why it's not. The risks from deflation are serious because if China is unable to meaningfully turn around the trend, it risks leading to a downward spiral with people holding off on purchases due to expectations that prices would continue to fall. Of course, the same thing happens in every economy because what we know is that consumer prices really tell us about demand. And when consumer price growth is slowing, or even worse, like in China, in deflation, it means in deflationary environment, there's less demand than there was a year before. In a disinflationary environment, it means demand is slowing down. When that slows, it eventually does impact the labor market, and it does in a big way. And that would overall dent consumption and spill over to businesses who won't need as many employees if there isn't demand. And yet, here we see President Xi has discussed China's stocks with regulators as rescue bets build for something big that would come into China, of course, send their equity markets higher. You know, that's another trade that our reports picked up. Stay tuned to Sunday's show as we'll give you a broad update on all of our trades. It's the news that nation's #1 is holding a meeting, an encouraging development as it shows the plunge is getting close to punching through authorities' comfort level. Gives me the impression they're doing everything they can apart from calling out to the market that now is the time to buy. Indeed, that is when people should be looking at buying stocks, is when things are at the worst, not when they're at their best. That is a key difference. Most people buy at the top. We show you how to buy near the bottom. And yet we turn over to the U.S., where everyone is celebrating a strong labor market, but for how much longer? That's the question, as U.S. initial jobless claims now drop for the first time in 3 weeks, as everybody is celebrating that perhaps Jerome Powell has indeed done the impossible here and engineered a soft landing. But the key part in any cycle, there's always this phase where you see inflation come down, the labor market doesn't have a big impact. So whether it's celebrating a soft landing or, as we saw on Sunday on 60 Minutes, perhaps a no landing achieved by the Fed chief, it's just a matter of hanging tight to see the direction the economy goes, because usually with 100% accuracy and throughout history, well, the economy continues to get worse. In fact, it just tells us we're in the eye of the storm. And when we look at, of course, unemployment claims, the headlines say that things are great because we're only at 218,000 claims. That's down 9,000 from last week, suggesting, again, the labor market remains strong. On an unseasonally adjusted basis, even that dropped 31,000 to 232. But really the risk isn't on the initial side, it's the continued side, because the longer somebody's on unemployment, the less money they have to spend. They still have to service their debts. It becomes an issue here. And what we can see is continued claims down 23,000. That's good, but still at 1.871 million. That number is too high. On a non-seasonally adjusted basis, we're over 2 million at 2.137 million. But get this, continued claims for all benefits unadjusted, now up a whopping 131,000 to 2.212 million Americans. That is going to have an impact, of course, on demand in a big way. The longer these people stay on unemployment, the less chance the U.S. economy has of pulling off this miracle no landing. The Fed chair is celebrating now. The labor market has proved surprisingly robust in recent months, powering consumer spending. Well, that's because a lot of people borrowed the heck out of everything they could get their hands on in the holidays, and that kept, of course, labor market strong. But recent high-profile job cut announcements from companies, including UPS and across the tech industry, may signal slower demand for workers in the coming months. And something to understand here is at the beginning of every year, there are companies they have positions they wanted to fill, and yet now what happens is they get the budget and they do that. The other challenge is they have positions they're trying to get rid of because they don't need them in that capacity. So you get some offsetting effects here. But what's not hitting the unemployment claims yet, well, is this list here by Zero Hedge that says this is the real world labor market. Well, for 2024, these are all planned announcements. It doesn't mean when these companies announce and say, hey, we're going to lay off 10% of our workforce, it doesn't happen immediately. It happens over time. And so that is the danger sign here, is if the economy cannot reabsorb these jobs, then that means the U.S. economy is going to be following China in the not too distant future. But of course, we talk about the effects of what causes consumer sentiment to rebound. Well, that's because inflation comes down. But what causes it to take that second nosedive? Well, it's the labor market for sure. Here you can see continued claims now overlaid against consumer sentiment. And what happens is, as claims go up, people actually believe in what they're being told by the political elites that the labor market's strong. But when they continue to be unable to find work, well, sentiment comes crashing down. You can see that here again, post.com bubble. You see it happening here during the global financial crisis. And right now, we note that the trend of continued claims is not going in the right direction. That could be a huge dent for confidence in the future. But of course, will the Fed do anything? Nope, because they're too fixated on the headline number now. As Fed is time to be patient on cutting interest rates. This according to Barkin, who clearly must not be paying attention to what's going on with New York Community Bank. As of this morning, their stock price continues to crash with no signs of it stopping in the future, setting off what could be the next big banking crisis and deflationary spiral. It's very strong labor market still, and so gratified to see inflation coming down, hoping it continues to come down. This recently said by Barkin. I think we've got some time to be patient. Well, you've only got enough time, Barkin, until the banking system implodes. But don't worry, if you think inflation is going to come down, it will. I will for a fact, because when people are on unemployment, they spend less money. It's a known fact. When people have less money to spend and they have a lot of debt at high interest rates, they do indeed spend less. And sure enough, we see now overlaying continued claims against the consumer price index. The CPI shown in blue, what we know is that as continued claims rise, that does have a negative impact on demand. And in every situation throughout history, what we can note is that leads to a big decline in the consumer price index. That yet to come, but it's going to happen in the matter of months. And so what is the big problem for China right now? Is it just a matter that global demand is slowing down and that's impacting them, causing factory gate deflation? The issue actually is partly that, but what's going on in the Red Sea is making it even worse, because what's happened now is shipping prices have skyrocketed to the point where we're getting a renaissance time here in the United States as factory data is picked up. We've noted that, talked about that on the show over the last couple of weeks. What's going to put China over the edge is the fact that people aren't going to order stuff from Chinese factories. And we're seeing that now as Maersk announces their earnings and their stock slumps after warning of a slowdown once the freight boost fades. Let's take a look. The amount of range of weapons that are being used for these attacks is expanding. There's no clear line of sight to when and how the international community will be able to mobilize itself and guarantee safe passage. We've not seen this level of threat peak. To the contrary, and that is an issue here, because that means people are not going to order from foreign factories out of Asia, particularly China, because they're going to look at the high shipping costs. They're going to also look at the additional time it's going to take to get there. They're going to go over to an American factory who is going to be charging a premium in general and say, you know what, we can do it here cheaper. It's going to give the U.S. economy somewhat, maybe of a few months of a boost in the data to look good. But the problem is China's economy isn't likely to survive this, as it's going to continue to head downward, and attempts by Beijing to put a stop to this, even if they cut rates, is probably not going to work. The attacks have dramatically slowed shipments through a key waterway that would normally handle about 12% of seaborne trade, and have tipped the balance between global shipping supply and demand, causing freight rates to soar and people to look elsewhere for their factory needs. And the Red Sea conflict doesn't come close to having the same impact as COVID-19. Well, because that was, we shut the entire world down. Now we're talking about shutting down the Asian manufacturing sector. That's the big difference here, is what people can see is China was already slowing down. They already have a property crisis. Their banks are already insolvent, and they just needed something to tip them over the edge. And this is exactly what it could be, because what people are suggesting is that the other recent global events had on raising shipping rates, it doesn't have that potential. Well, if you're China, it absolutely has the potential, and no matter what Beijing does in terms of stimulating the economy, whether they cut rates or inject money, they still need and rely on the rest of the world for demand to turn their economy around. That tells us the U.S. economy now likely to lag where China's at. I'll give them about 90-day lag behind that. We'll see how this goes. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.